All right, welcome everybody. This is now our third session on options, so this should be quite interesting. I hope everybody's had a good day. Markets were pretty good today. Market's been great for over a week now, right? So yeah, I'm sure everybody's feeling pretty good. Hopefully your portfolio is doing well. So today we're going to be doing part 3 of our options, and we're going to start getting into we're going to look at a strategy, really a fairly easy strategy, one that Warren Buffett loves to do, and a strategy that works well for both traders with some modification, and especially well for investors. So I think you'll find that interesting. And then going forward from here, we'll try and bring more strategies in and start, creating a playbook of types of trades that you can make with options. So yeah, we're calling this session Harvesting Time Decay. And we'll get into more later about why I'm calling it that. And first of all, of course, we're the disclaimer that we always have to go through. So everything we do here is for educational purposes only. We are not investment advisors, and we do not provide investment advice. All statements made here are my own personal statements and are not to be considered advice to buy or sell any security. All trading investment decisions are your own. All right, so I think everybody knows who I am. Kevin D in the Discord. I've been doing this since the mid-90s. I've been a full-time trader for getting close to 3 years now. And I'm currently a CMT level 2 candidate, having passed the CMT level 1. Born and raised in Vancouver, and love doing Vancouver stuff like, sailboat racing and hiking, riding my bike, that sort of thing. So that is me. So why don't we dig right into what we're going to be looking at today. So we're going to start off with a really quick review of some concepts we've covered in previous sessions, but I'm going to stick to the ones that relate to what we're doing today. So just a little bit of reminder of some of the things that we'll be using today. I wanted to look at SHOP, what happened with SHOP on Friday, because I think it's really interesting. It was really dangerous, and it cost a lot of people a lot of money. So I want to look at that because I want to show you how you can avoid it costing you a lot of money. It's a really rare occurrence, but it does happen. And if you're going to be trading options, you kind of need to know your way out of these situations because weird things happen. And you'll see as we go through this thing with SHOP last Friday. We're going to look at just one new term today, and that will be Theta, which basically means time. And we're going to look at Warren Buffett's favorite option strategy. So without further ado, let's just dig right in. Okay, so we'll go through some review first. So a little later on in the session, we are going to be selling put options. So we need to make sure everybody knows what a put option is. And if you have any questions on this, please let me know, because it's really important for later that you understand, what a put option is and what your obligations are when you sell them. So put option is an option contract that gives the owner of the contract, who is the buyer of the contract, the right, but not the obligation to sell the underlying stock at a specified price, its strike price, for a certain period of time until expiration. Okay, so if you own a put, say with $100 strike, and I sold that to you, I sold the put. So I sold short a put, you bought that put. You have the right to sell me that stock for $100, and it doesn't matter whether that stock is trading at $1 or $1,000. Obviously, if it's trading at $1,000, you're not going to sell it to me for $100, are you? But if it's trading at $1, you're going to be pretty darn happy that you have the right to sell me that stock for $100. Okay, does that make sense to everybody? And I just kind of covered the second part of that. So for the put writer, the person who sold the put option, the contract represents an obligation to buy the underlying stock from the option owner if the option is assigned. So I'm required to buy that from you. If you say, yeah, I want you to buy these stocks off me, Kevin, I'm required to do that. So hopefully that all makes sense. And this is stuff we should probably already know anyway, if we've come this far. Let's take a quick review on implied volatility rank, which is also known as IV percentile, because we're going to use this. We're going to use this briefly later as well. So IV rank, or implied volatility rank, is a metric used to identify an option's implied volatility compared to its IV history. It's kind of a bit of a mouthful, so let's just tear that apart a little bit. So it can be used to determine if an option is currently cheap or expensive. This is like the whole key to IV rank is deciding, is this option a good deal to buy right now, or is it a bad deal? Is it expensive? Is it cheap? And it gives us a really good idea of kind of where it sits in its history. So it helps us decide which option strategies are most advantageous given the current implied volatility. And we'll see how we use this later as well. Because IV implied volatility is mean reverting, we can expect that extremes in IV rank won't stay extreme for long. So what I mean by mean reverting is basically, implied volatility rank is the percentile that goes from 0 to 100, because it's measuring, where is this? Where is implied volatility right now in relation to its norm? So its norm should be around 50, right? So if IV rank is out at 100, it's very extreme. It's not going to stay there. It's going to pull back. It's going to want to come back, to a more normal level, which is probably around 50. So an example, I just kind of went through that, but an option with an IV rank of 90% means that IV on that option is higher than it has been 90% of the time over the past period we're comparing it to, which is usually a year. We're usually looking at, where is IV now compared to where it's been over the last year. Okay, so if it's at 90%, it means it's higher than it has been 90% of the time. Or another way to look at it is it's only been higher than this 10% of the time. So an option with an IV rank of 90% is expensive, right? Because we're going to expect that implied volatility is going to come down, and probably come down quite a bit. And when that does, the price of the option is going to come down as well. So this we'll see how this works later, but when something's got an IV rank of 90, we probably want to be selling options in that situation, not buying them, especially if we're going out sort of longer term, right? And conversely, if IV rank is only at 10, we probably want to be buying options because they're cheap. We expect implied volatility is going to go up from there. When implied volatility goes up, option pricing goes up. So if we buy options when implied volatilities or when the IV rank is only 10, we're really putting we've got a really nice tailwind behind us to help us out. Oh yeah, and I've got we're going to look at this website later. But it is marketchameleon.com, and then the overview and Apple. But just look for implied volatility on that website on Market Chameleon, and you can see a really simple, easy way to find out implied volatility rank. Some broker platforms put it in the option chain as well, which is really handy. Okay. So does everybody understand that so far? Everybody understands puts well enough and how implied volatility or implied volatility rank works well enough that we can move on. I don't see any questions, so I guess everybody's cool with this. Okay, so we're going to take a look at Shop. And I've called this a cautionary tale because, like I said, a lot of people lost a lot of money. And I don't know if you were watching Shop, or we talked about it a little bit in the Discord, because it was kind of a crazy move right at the close. And it was very unusual. Initially, I thought it was a bad print, but it turns out it wasn't. It was a real trade. So we're going to look at what happened to shop at the close, okay, and how it relates to options expiration and how we can protect ourselves. So so it's important for this to remember that last Friday was quad witching. And quad witching, if you don't know, it just means that basically a lot of different kinds of options contracts and futures contracts are expiring. And that can create a lot of volatility. And we certainly saw some of that, coming into the close on Friday in a number of stocks, not just Shop. And actually, Shop wasn't even all that volatile. But what's probably more critical to a critical piece of this story is that Friday was also index rebalancing. So the S&P 500 index, is a cap weighted index. They were rebalancing at the close on Friday. And what that means is any of the ETFs that have stocks that are within the index also have to rebalance at the close. Okay, so if a stock's weighting in the index goes up because of this rebalancing, there's forced buying. All the ETFs that own that stock or are tracking that index, they have to buy some of that stock. And they do it pretty much at the close. Now, for the hedge funds who are kind of trying to track the S&P 500 or something like that, or track a particular index, it's a little easier for them because they can probably be buying in the days ahead of time. They can figure out what the rebalance is going to be, how much extra stock they need to buy. They can spread their buying out. But for the ETFs, they can't. They generally have to do it right at the close. So that, I think, played a part in this issue, this strange issue with Shop. Okay, so on Friday, the official closing price used for options expiration was $7.80. Okay, but is that really where it was trading? And we'll see when we look at the chart, which we'll do right now. That one right there. Okay, so I've got a daily chart of Shop. Okay, and I've cut this off at Friday, and you can see the daily candle here, really big candle. And you can see, just looking at this, it closed at 780. Okay, fair enough, right? But if you look at what went on during the day, you'll see that it didn't trade anywhere near 780 coming into the close. It traded once after the close at 780, and it never got there again. And I can show you this. We can look at something called a tick chart. I don't think I've ever showed you guys a tick chart before, but basically what this is, every one of these little black marks is an individual trade. So you can see coming into the close, we were trading right around 692-ish, and you can see the very last tick, I think that one right there is the closing tick, and that was in around 693 or so. So that's where it was trading around 693 as we come into the close. And then you can see here's the after hours, right? And you can look down at the time here, 1600, it's 4 o'clock in New York. And then here we see at 1605 and 30 seconds, we see this giant green candle, 133,000 shares traded in one single trade. And you can see that trade way up here. It's kind of hard to see. Maybe I'll highlight that a little bit for you. But right inside here, in the middle of that yellow box, okay, you see that little black line at 780. That was an actual trade. So it's like, how the heck does this happen? So we'll go into that in a sec. But we'll back up. We'll see. This is really unusual, right? And this is why when I first saw that, I thought it was a bad print. If we look at a 1 minute chart of this, it kind of makes a little bit more sense than on the tick chart. Makes more sense if we do this to it. There we go. So this is a 1 minute chart. Okay, and you can see that coming into the close. So here's the last hour before the close is right in here, and you can see that coming into the close, they started to rise a little bit, And then all of a sudden, 5 minutes after the close, we get this one big tick all the way up to 780, and then it pulls right back, almost all the way back down, and there just starts falling off. And then, kind of through the rest of the after hours, it's in around 700. And then we see another one right here. This one is actually a bad print. For some reason, this one here kind of repeated. But you notice on this one, see, there's no volume on this one this time. Okay, so hopefully that makes sense so far. Let's go back to that guy. Yeah, okay, cool. So yeah, I also wanted to show you the time and sales. So that's another way we can look at this is using something that's called time and sales. And I cut this out and pasted this in the Discord on Friday, late in the day on Friday, when somebody was asking about what happened to shop. And you can see here, so I'm only looking at trades on the New York Stock Exchange, because it's the last trade on the New York Stock Exchange that determines what the official closing price is. And the official closing price is important because that's what they use to determine options, right? So you can see all the trades coming into the close on various exchanges, and there are some, condition codes right here. But the important thing is you look at the price here in the last second of trading, 691, 691. Here's one of 692, 692, 691, 691, and then it closes, right? So we go from 359.59. And the very next trade is at 405.27, and that's the 780 trade. And you can see here on the condition, it says closing. So this is the official closing price. Pretty interesting, right? Or totally confusing. Hopefully you're following along with me here. This will all start to make sense in a minute, and you'll understand why shortly, why we're looking at this. Okay, so this is just reiterating what I said. We see that last trade at 691.06, and then the very next one we see at 405, we see the official closing print at 780. Okay, so therefore, 780 is the price that we use for options expiration. But why? How did this happen? All right, so we've seen that 780 was a real trade. It's really there. So why is that a real trade? Okay, so somebody went in there with an order for 833,000 shares, and they used what's called a market on close order. Now, everybody knows what a market order is, right? When I put a market order, you put a market order in, you're telling the exchange to buy that stock at whatever price it takes to be filled. Okay, so if the stock is trading at $691 and you're only buying one share, chances are you're going to get filled at $691. If you put in a market order for 833,000 shares, what do you think is going to happen, right? You're not going to get filled at $691. Is there really 833,000 shares available for you to buy at $691? No. So what happens is it starts working its way up through the book. Now, there's always orders sitting all the way through the order book, right? All the way up to, probably near infinity or whatever. There will be sell orders up there. People are just put an order in that's good till canceled, thinking that maybe I get lucky, maybe something weird happens, my order gets filled. And that's exactly what happened last Friday. The market makers, with these market on close orders, they have to find buyers, and they look through the book and they go, okay, we've got to go all the way up to 780 to find 833,000 shares. That's the price this is trading at. So somebody bought the 833,000 shares for $780 when the thing was actually trading at 691. Pretty dumb, right? Okay, so this just reiterates what I just said. So why does this matter? It matters because, actually, I want to back up. Okay, can't back up. There we go. Can anybody tell me why this matters?
Because it raises the price, the stock?
It raises the price, but what happens if you owned some calls on shop? Let's say you owned calls at $730, a $730 strike that were expiring on Friday. What do you think happens to you, Callie? Or anybody?
I actually make more money. Right? Well, if it closed, it was after close.
Yes.
Right?
Yeah.
So it's not a good thing.
You're right. It's
The
not
volatility, right?
Well, it's not the volatility, but I'll go into why. I'll explain why. Okay. So if I can get my slide back, there we go. All right. So let's say you owned the March 18th, $775 calls, or any call below that. When they print a closing price of $780, all calls with strikes of $775 or below expired in the money, right? So they were automatically exercised at the strike price. Now, if you owned the 780 calls, they wouldn't be auto-exercised because the option must be, or sorry, the closing price must be 1 penny higher than the strike. So anybody with 780 got lucky; they didn't get screwed on this. But so that brings us down to the 775 and lower calls were all finished in the money, even though the last trade of the day that we got to see was $691. So that 775 call should have closed out of the money, right? So if you owned those 775 calls at 4 o'clock, you look and go, oh, well, shop closed at 691. My calls expired worthless. I'm going to go out for a beer with my buddies. And you forgot about it, right? I mean, it's okay. It was a losing trade. No big deal. It happens all the time. Your calls will expire worthless all the time if you do this long enough. But then on Monday, you come in and you discover that you bought 100 shares of shop for $775 each. And now those shares are only worth $699. Because that $699 was the opening print on Monday morning. And you're thinking to yourself, how the heck did that happen? I was watching shop at the close. It closed to $691. And so this is how that happened. So you can see now, your 100 shares, you've just lost $76 a share on those things, right? Or a paper loss of $76 a share that you're down. Now, if you're the poor guy who put in that market on close order for 833,000 shares, that guy's down $65 million on his stupid mistake. It's just shocking that somebody with that much money can make that kind of mistake. I'm sure somebody got fired over this. This brings up a really important question. How do we protect ourselves from this? So first way that you can protect yourself from this happening is when you see that you've got options that are clearly going to expire worthless, try and sell them. You might be able to get a nickel for them. It can sometimes be hard because nobody wants to buy them, right? Especially the farther out of the money they are, nobody's going to want to buy those things. And if they're close to the money, you might want to hang on because, maybe you will be able to get some money out of these if you hang on right to the close. But, just be aware there's a little bit of danger in that and hanging on to these things right to the close. So if possible, try and get out of them. It's likely, though, that you can. So the next thing you need to do is you need to watch the price action for at least 10 minutes after the close. You need to wait until that official closing print comes in. In shop's case, and it takes a while because the market makers are trying to match up all, the buy and sell orders, all these market on close orders, because there's a lot of them there. Institutions use these orders for some reason, and they'll often have a lot of them. And no doubt on Shop, they were trying to balance this out. I mean, but the market makers didn't want it to go to 780. I mean, nobody likes this except the guys who got to sell Shop at 780 and then 30 seconds later got to buy it back for 700, right? That's a beautiful trade if you ended up selling it short there. So yeah, watch the price action for 10 minutes or so afterwards and see if you see anything weird going on. This sort of thing that I had showed you. If you see any price action, makes you think that they closed in the money, take a look closely and then decide, do you really want to be assigned 100 shares at that price? So in the case of Shop, we'll just go back to the chart really quick. It's pretty obvious. It's pretty obvious when you see this happen, right? It goes way up here to 780 and then it comes right back down and it settles in at around 700. Well, I don't want to buy 100 shares at 780 or 775 or wherever in here your strike was. You don't want that trade, and you can get out of this. Okay, when you've got options and this happens, you have, sorry for the pun, but you have options. There's a way out of this trade. Okay, so I'm going to show you, or tell you what that is. So if you see this happen, all right, you have until 5:30, or your broker has until 5:30 to call the options clearinghouse or the options clearing corporation, okay, to call them and say, do not exercise these calls. So you need to call your broker. As soon as you see this happen, decide that I don't want this trade to go through. You call your broker and you tell your broker, do not exercise these calls. And make sure that they understand and get some sort of reference number in case something goes wrong. And the closer you can, the sooner you can do this after the close, the better. It's a simple and easy way out of what can be a really expensive situation. Now, on some broker platforms, you have the option of assigning that or tagging that option with do not exercise. I've looked for it in IB and I can't find it. I thought that IB had it, but I guess they don't. I think that Tracer or Thinkorswim has it. But again, this is something you're going to want to look at. But I guarantee you, if you trade options long enough, something like this is going to happen to you. And something like this has happened to me. It didn't cost me much. It barely cost me anything at all. It all kind of worked out well in the end. But it's happened to me. And I promise you, eventually you do this long enough, it's going to happen to you as well. And so knowing your way out, knowing your escape route out of this, I think is really helpful. And that's why I wanted to go through this. I know this took a while and some of it might have been a little confusing. But now now you know kind of what to watch out for, and you know how to get out of it. And if this does ever happen to you and you're a little confused, you're unsure if it's really happened to you, what you should do about it, feel free to DM me. If it's after hours, there's no guarantee that I'll get it right away. But if I'm online and you ask me a question like that, I will definitely help you right away. So is that clear on everybody? Does anybody have any questions about that?
I actually do have a question.
Okay.
So I'm just confused. This is if I would have bought the call or if I would have sold the call to open.
No, so actually you bring up a good point. Let's look at both sides of this, Callie, because this is, this could actually end up being really cool for you. So if you owned the call, so you could have bought that call a minute before the close, or you could have bought it a year ago, right? If you own that call, if that call closes so that you're in the money, if it's in the money at the close, you are going to be exercised. It's automatic. Okay, so, and that means that you are buying 100 shares at the strike price. Now, ideally, I mean, this usually works out well for you, right? Because let's say you had a 7:30 call on Shop, and Shop actually closed at 780, and it continued to trade up there at 780, right? It traded normally. It went up through your 730. It went up and up and up during the regular trading hours, and then it finally closed at 780. Okay, you want to be exercised because you're buying Shop at 730. You're buying it at your strike price, so you're in the money by 50 bucks. So of course you want to be exercised in that situation. But in this situation where there was one single trade that just threw everything out of whack, you definitely do not want to be exercised, because as we saw, the price came right back down. And suddenly, 1 second later, you're losing, 80 bucks on that trade. Or if you'd had the 730, you'd only be losing 30 bucks on it, right? But if you know the Shop's going to be at $700, you don't want to be exercised automatically at 730, right? Okay, so let's look at the other side of this. Let's look at the guy who sold 775 calls. He is required, or actually, sorry, he doesn't have a requirement. No, he gets to sell you. So if he's sold, someone who sold 775 calls, when this closes at 780, all right, he's now required to sell 100 shares of Shop at 775. Now, 1 second later, when this is down at 700, he's thinking, wow, this is really cool. I just sold Shop to somebody for 775. I can buy it back right now for 700 bucks. So it's working for him, right? So for the person who's long the options, for the buyer of the calls, it's not working out at all. But for the seller of the call in that situation, it worked really well for him. That makes sense, Kelly?
Yeah, I understand what you're saying.
Cool. All right. If there's no other questions on this, we will move on and start getting into a new strategy. Okay, so obviously, with options, there's lots of terminology, and we've got to learn the language of options, and we're going to learn a new term today, and that term is theta. It's one of the Greeks. We've previously looked at delta. Today we're going to be looking at theta, and theta is also known as theta decay, which is also known as time decay. So theta represents the time value decline, or the decline in the value of time of an option contract. So when you buy an option, it's got two values in it. It's like, what is the option actually worth compared to what the stock is trading at right now, and then how much time value is in there? How much am I paying for the time that I'm going to be holding this? And so that goes down day by day. That time value is ticking down, right? And that is called theta. So theta is represented by an actual dollar or premium amount, and is calculated on a daily basis. So, and it's always changing. It's changing every day. Day by day, it's a little bit different, and it also changes with the price of the option. So it's recalculated basically daily. So a theta of 1 means the option contract will decline in value by $1 per day. Okay, so that price, if you bought an option contract for $10, and it's got a theta of 1, well, every day it's going to be worth $1 less. So implied volatility affects theta. As implied volatility rises, the theta is going to rise as well. So yeah, in general, the higher the implied volatility, the higher the theta. because with higher volatility, it means we're expecting that to the stock price to move a lot more, right? And therefore the theta has to be higher. So theta decay is nonlinear. All right, that means that theta decay accelerates as expiration approaches. And I've got a cool little picture here to illustrate that. So you can see here, we see it over on the y-axis, we've got time value. On the x-axis, we have time, how many days to expiration. We can see 90 days. So in 90 days, the theta decay is pretty flat, from 90 to 60 days. The value, or the time value that's in this, right, decreases very slowly. And then as we get from 60 to 30 days to expiration, we can see this time value decay really sort of start to accelerate, right? And then once we get inside 30 days, it really starts to get steep, doesn't it? And the amount of time value left in this option really starts to fall off. So if you're selling options, one of the things you want to have happen, you like this time decay, because when you sell options, you want that option to go to zero or get very near zero so that you can buy it back for next to nothing, right? So the sweet spot is kind of right in around here at around 25 days or so. Now, some people like them out here at around 45 days, and some people like it here at a week. But I found for me, this, the sweet spot is about 25 days, because it's really starting to get steep here, and it really starts to lose that time value quite quickly. So it's a nice little tailwind when you're selling options. Okay, and we'll see why this is important a little later. So another way to see this, okay, so this is our option chain, and you can see I've highlighted the theta column here, and a couple things I want you to notice. So right here, what's our price here? Yeah, 559 is where Costco was when I captured this. And so we can see, basically our 560 strike is the at the money strike, okay? And you'll probably notice here that you can see the difference in the theta decay as we move up and down the option chain. So we can see at the 560 strike, our theta decay says minus 0.271. That means that this call is going to be losing 27 cents a day right now. So every single day that I own this call, if I was long this call, I'd be losing 27 cents on its value. And we see our midpoint on the value here is $12.10. So you're thinking to yourself, well, if it's losing, there's only 23 days left, and 23 times 27, that doesn't add up to 1210. Well, remember the nonlinear nature of theta decay. This number is going to get higher as time goes on. It's going to start losing more and more. So a week from now, this number will probably be 40 cents. It'll be losing 40 cents a day, not 27, okay? Also notice that as the value of the option decreases, okay, so if we look down here at the 610 strike, that's worth 77 cents. It's only losing 8 cents a day right now. And if we go way up here to the top, at 495, this is a $65 call, and that is losing, why is that losing 10 cents? That's a weird, that one's odd. I'm not sure what's going on there. I think I captured this after hours, and sometimes weird things can happen after. Oh, I know what's going on. It didn't trade that day, so we're getting a weird number. That's why. Yeah, if we look at one that, the ones that have actually traded, the numbers are more accurate. But yeah, so this is good to know. But you'll notice that as we get farther out of the money, theta decay is less, and that goes both ways. Okay, so theta decay is highest when we're at the money. So that's the important concept there. Anybody have any questions on theta? All right, we will continue. Okay, so we're going to get into the strategy now. So selling puts and harvesting theta decay. So this is Warren Buffett's kind of favorite trade. It's really how he's made most of his money, is in trading this way. And there's a couple of really famous trades he's done this way. One of them was Coca-Cola it was in the 90s, maybe. It might have been even earlier than that. But it was just an absolutely killer trade for him. He made just millions and millions, just an obscene amount of money on this one trade in Coca-Cola. I don't have the details of the trade, but it's an interesting story if you want to look it up. So what we'd like to do now is ask Papa Buffett about his favorite strategy. And I have paraphrased here both things that he said and what we know about his strategy. I've sort of paraphrased that and turned it into a quote, but I'm not going to do a Warren Buffett impression though. So it's simple, really. I sell short overvalued, long-dated put options on great companies and get paid while I wait to buy them. So what he did on Coke, and when he says long dated, he means really long dated. I think on Coke, the puts that he sold had something like a 10-year expiration. And this is something Warren Buffett can do that you can't, or you and I can't, right? He can actually go and have special options contracts created. It's just a contract like any other, right? So he can go and sell these puts to somebody, and the saying that I will buy the stock at X amount of dollars at 10 years in the future. And he made something, I think it was close to $100 million off this one trade, 10 years later. Bought Coke for basically next to nothing, 10 years later. And because he'd sold them, he collected premium. And he got to put that money in his bank or use it to buy other stocks, and got to use that money for 10 years. So, I mean, that's fantastic, because you convince somebody to give you a bunch of money, and then at the same, you get to use that money for 10 years, and then 10 years later, you get to buy stock from them really cheap. It's a really good deal. So, where does this strategy sort of fit into our decision matrix? So he's selling puts, right? And selling puts is right down here, and it is in the stock opinion on that then is bullish. So you're going to do this on the stock that you're bullish on, okay? And if we go across to here and we're looking at the volatility opinion, we're going to see that we're bearish, okay? So if we're bearish on volatility, that means we expect volatility is going to go down. Therefore, at this point in time, volatility must be high, right? Implied volatility rank must be really high. That's why we're expecting it to go down. Or maybe we expect the stock to go sideways. There's a lot of different ways to think about this, to use this trade. And if you think about it, once we sort of go through the whole thing, you'll see that, yeah, if I think a stock is going sideways, maybe selling some puts, even if volatility isn't that high, selling some puts may be a good idea if I think the stock will continue to go sideways. That's another way to look at this trade. You can modify it and vary this to suit your own purposes, whether you're a long-term investor or a short-term trader. Okay, so let's get into the detail on this. So how are we going to make this trade? Well, the first thing we're going to do is find a great company. That's something that Warren Buffett is really good at. And, that's something that a lot of us in the Discord are really good at too, right? If you're really good at going through fundamentals, somebody like Nick, for instance, could use this trade very successfully, I think. Guys like Ari or Carter and some of you who are here today, are good at finding great companies. So then we want to decide, are the options overvalued? Do they have an IV rank of greater than 60, 70, 80, even higher than that? This is a number you have to decide for yourself. You've got to figure out what is comfortable for you. 60 to me is on the low end of things. 80 is getting pretty juicy. And even higher than that is practically a no-brainer. Assuming everything on the chart looks good and it is a great company and there's nothing weird going on right now that's causing volatility to be so high. And I was going to show you where we go, to find this IV rank. So let's go over to, so this is Market Chameleon. Okay, I've showed this to you guys before, but if we look at Apple, and Apple is a great company, right? Is Apple a candidate for this strategy? And I would argue no, because if we look right here, if we look at IV rank right here, we see the IV rank is at 39%, and it's telling us that's moderate. I would call this kind of low, definitely very low for this sort of strategy. What about another great company like maybe Google, for instance? Getting better, right? IV rank of 58. Okay, so this is passable. It's still a little low for my liking, but maybe for you, this is good enough. What about another shop that I know, or another stock I know that has been fairly volatile is Shop. Okay, and if we look at this, we can see the IV rank is at 87%. So this is very elevated. Now, you could argue that maybe Shop isn't a great company. For today, let's just pretend it is a great company and it's got great fundamentals. And we think that with IV rank at 87%, options are overvalued. Okay, so that's going to be our thesis going forward for today, whether that's true or not, right? Okay, so what is a great price to pay for this company? You've done your fundamental analysis. You've figured out what fair value for this company is, and maybe you've looked at the chart. So why don't we take a look at a chart of Shop, and let's just bring this over to here. Okay. So obviously we see that Shop has fallen off a cliff. This is the daily chart, by the way. Let's just take a look at a weekly and get some more context here. I don't have this marked up though, but you can see that we've got a support area right here. We had resistance right here before, and we bounced right down here. This is a weekly, by the way. We've got some support just below here at around 316 or whatever. What's that, like 500-ish? Okay, so down in here probably would have been pretty good, because we did have some support there. So we're a little late today on this, but maybe this is still good enough. We would have been a lot better off doing it on this day that it bounced. You can see a steep downtrend, and then once this had bounced, or maybe up into this candle here, we can start thinking that, hey, we got a double bottom here, right? Maybe there's an opportunity here. So let's just pretend that one of these two green days, we're looking at this and thinking, okay, now is the time to buy some puts, sell some puts. You don't want to be selling the puts after a big run when it's run all the way up here like this, because it's kind of overextended, right? It's getting a little overbought. It's likely to pull back a bit. You want to sell the puts after it's kind of moved down, is showing you some bottoming action, and maybe even bouncing. Or it has bounced and it's come and it's consolidated. Okay, we've got a bull flag here. So maybe we expect this to break out to the upside. So we're thinking about buying puts, we're thinking about selling puts for this strategy, because I'm okay with buying more of this stock somewhere under, say, $500. All right, so I think that $500 is an excellent price for this company. If I am forced to buy stock in Shop at $500, I'm a happy guy. If we get a pull back down to 500 and I get assigned on these puts. All right, let's go back over here. So we've decided, everybody agree, $500, good price for Shop. All right, so now we've got to find puts to sell that give us a good return on the time frame I'm comfortable with, and with a low probability with assignment. You know, I'm cool with getting assigned at 500, but I'd kind of rather not. And maybe you would be. Maybe you really want shop, then you really want to get assigned, right? Maybe if you're just trying to earn some income while you're waiting to buy shop, then you don't necessarily want to get assigned. Okay, so if we're gonna, right, okay, we need to look at the option chain on this, which I've got right here. Okay, so how do we know what is a good deal? What are good puts to sell? We know that we want to, we think that 500 is a good price. So that's the first place we're going to look, because the chart told us, 500 is an area with support. If it goes to 500, it's probably going to bounce there. So the chances of getting assigned at $500 are pretty slim. And if we look at the delta, we can see that it's only 0.044. So there's essentially less than a 5% chance that we're going to get assigned. And these, I'm looking at the monthlies here. This is April. There's only 21 days left in this. And we can collect, where's the midpoint in this? $3.15. So $315 that we can collect in premium by selling those puts right now. That's, probably not a bad deal. Can we quantify this? Can we really see that this is not a bad deal? You bet we can. I'm going to bring up a spreadsheet here. I've already filled this in. I'm going to give you a copy of this. And for now, just ignore this section at the bottom down here. Like from right now, just ignore all that piece right here. We're going to be working at the top here. I've already filled all this out with information that we're getting from the shop option chain. Okay, so first thing I want to do, what is the current stock price? And we can also put in here a stock price basis. This will be used in a calculation later on, but we don't own this stock, so this will just be the same number. Okay, so the current stock price on shop, $703. The implied volatility is 71.2, and there's 21 days to the event. Okay, now this event could be earnings, could be any event coming up, but in this case, the event is expiration. All right, so let's take a look at our option chain again. Now this is Interactive Brokers, but all this information is usually in any option chain that you looked at. You can see we've got the price up here, close enough to 703. The IV, implied volatility, 71.2. That's where I got those numbers. Okay, let's go back over to this. Now, I took a look down. So what this is going to do, it's going to tell us the implied move. How much do I expect the shop is going to move between now and expiration? And given the implied volatility, that move is going to be 17.08%. And in dollar terms, that's about 120 bucks. So what I've done then is I've taken the 703, I've subtracted the $120. It's done this automatically for us, okay? You fill in these white fields, and all these yellow and other yellow, green, red fields are all going to fill in automatically. All right, so we can see here, $703 stock price, expect to move is 120, days of expiration 21. Now, the strike price that is at one standard deviation is 582.94. And then at 1.5 standard deviations is 522.91. And then we've got 2 standard deviations. All right, we look down in the next field here, we look at 1 standard deviation. We can see that the probability of us winning on this trade, or the probability of these puts expiring worthless, okay, is 68.2% at the 1 standard deviation. So the strike price closest to this number right here is 580. So I filled that in there myself, and then I went and looked in the option chain. I found the option premium is 950. All right, and then if we move across here, it will extrapolate this and tell us what is that as an annual return. If I just kept doing this particular trade over and over and over, I could expect to make 23.49% on the capital required to make this trade. And then we can look at 1.5 standard deviations, which gives us an 86.6% chance of success. of these options expiring worthless and us keeping all of that premium. Okay, so that gives us a strike price of 520. That's getting a little closer to where we thought, was a decent price for shop. And we're collecting $4.30 in premium on that, and that would be close to an 11% return. Now, if we go to 2 standard deviations, there's a 95.4% chance that these expire worthless. We don't collect as much premium. It's only $1.75, and it's not the greatest return over the course of a year. It's only 4.3%. So it looks like, kind of the sweet spot here is in around, the 500, the 520, somewhere in there. Because of the way the chart looks, I would stick to the 500 on this. You may want to do it differently. You might get really enticed by the dollars here, by the 950. Okay, and this 23% annual return on that. That's okay, but it's a little dangerous, right? Because essentially, 2 out of 3 times you're going to win, but 1 out of 3 times you're going to get assigned, and this may not be the best price to get assigned at. Does this make sense to everybody? And again, I'll put a link. I'll actually drop this into the session recordings channel after the session, so you can have this spreadsheet for yourself. Now, I wanted to do a comparison of what happens if we go way out in time. Okay, so what happens if we go, if we look at the options that are, say, almost a year out. So if we go to March of 2023, and you'll see that the premiums available to us are much, much higher, right? There's an awful lot of time value in these. And if we look at our theta, we're decreasing at 20 cents a day, but we've got 358 days to go. So tons of time value in here. The problem is that when we look at, so now we're looking at the bottom one here, right? So all the same information except implied volatility now is lower. Days to event is obviously a lot higher. And look at this, over the next, just under a year, we're expecting shop to move 58%, and that's $400. Okay, so that's a fairly big move that needs to be priced in. So if I even get to 1 standard deviation away, so have a 68% chance of these expiring worthless, I've got to go all the way down to the the $300 strike. I will collect $15.65 in premium, but that's only a 2.27 return. So you can see that going way out in time, and it looks great. Hey, I'm going to collect $15.65, which is actually $1,565. That looks great, but really, considering how much time you have to spend in this trade, I think you're better off, doing this kind of every month at around 25 to 30 days to expiration. You can get yourself much better returns doing it that way. We only have to do it 4 months in a row, and we're already collecting more premium than we're collecting down here. One of the other problems when you go way out in time, you can look here. I mean, it's telling us that we want to, we look our 1.5 standard deviations. We want a strike price of $92. And at 2 standard deviations, well, we have to get negative. I mean, that's just not possible, right? So, it's kind of pointless even trying to giving ourselves greater odds of success here. So yeah, I like to do these shorter term, unlike Warren Buffett. Okay, so let's go back over here. So we found the puts that we want to sell. We collect the premium, and now all we got to do is wait for expiration, right? In a perfect world, these expire worthless. If they do, then we're going to repeat the process. So, however, maybe we get assigned. So if we're assigned, excellent. We wanted to buy that stock at that price anyway, right? So if the stock goes a little bit below there and we get assigned, it's all good because we know it's a great company. We know that stock is going to go higher in the long run. We're going to be in the stock for a long time. No big deal. So we now own 100 shares, 100 shares per put that we sold, at a price our analysis told us was a great price. Let's say the put expires worthless. We don't get assigned. Excellent. We collected all that premium. We got to use that premium, and we get to keep it. We have no more obligations now. That money's ours, and we can now turn around and repeat the process. We'll go and we'll look through again. We'll see, well, what's a good price? Maybe that same strike is a good price still. Maybe not. Maybe things have changed a little bit. Maybe we want to adjust where we're going to do it the next time. But you can see that, until you get assigned, you can just do this over and over and over. And you're making money while you're waiting to buy this stock at a great price. This is the beauty of this strategy. It's a really nice way to end up buying a stock, a company you want to be in long term, and make money while you wait to buy it at an excellent price. Does anybody have any questions on this so far? Do you guys, what do you think of this? Do you like this strategy? Is it something you think you could use? All right, not seeing any questions. If I do see any questions come in, we'll go back to them. All right. What we want to cover now is what happens if something goes wrong. So, something could go wrong, like the stock could drop a ton, or our thesis could change while we're in this trade. And it could be anything, right? I've listed, a number of things that could happen to the company while we're in this trade that could cause the stock price to drop precipitously. It could go way below our strike, and could also cause us to change our thesis on the company. Maybe it's not a great company anymore. So what do we do when that happens? And there could be any reason for that. Ideally not the last one. Just changing your mind is probably not good enough. If you change your mind because some of these other things happen, then fair enough. So what we can do is, if the stock drops suddenly and we no longer like this company for fundamental reasons, we could just buy that put back and take the loss. This is the easiest way to deal with it. Not all trades work, not all investments work. Sometimes you just got to take the loss. This is the easy way out. It's not the only way out, and and there is a way out that you probably don't take a loss. There's still risk involved, but we're going to look at a method of sort of working our way out of this over time without taking a loss. And to do that, we are going to roll the put out and down. So what that means is, so when we roll a put, what we do, or when we roll an option, whether it's a call or a put, we buy back, in this case, the put that we sold. Okay, so we need to buy that back, and we're going to have to pay more money for that than we collected, right? So we're losing on that. So we buy that put back, and then what we're going to do, we're going to look to the next expiration month out or farther out in time, okay? And because it's a put, we're going to be looking down the option chain to try and collect, to sell another put, right? And collect that premium back that we just paid to buy our old option back, our old put back. So here I'll go step by step through this. So rolling a put out and down. So before, you can't do this after expiration. At expiration, if that put's in the money, you're going to get assigned. Okay, so this has to be done before that expires. And I would suggest doing it at least a few days before. If it's deep in the money, you probably want to do it a few days before, because people will be getting itchy fingers to exercise those options, because somebody's going to be making money by exercising it, right? So don't wait until the last second to do this. Do it a couple or a few days before expiration. Determine what it will cost to buy the put back. All right, so you just got to look at the option chain. We can go to an option chain now, and let's go back to an April here. Let's just say let's see, let's find one that's in the money. Let's say 750. Okay. Let's say we had sold a 750 put. Now we need to buy that back. All right. So that 750 put now is going to cost us, let's call it $75 to buy back. All right. So there, we have determined what it will cost to buy back. It's going to cost us 75 bucks. All right. Let's look out to the next expiration month. Because in the next expiration month, we want to find a strike. We want to find a put strike that's valued as much or more than the put I need to buy back. All right. So that's going to be $75. So let's take a look. Let's go out to, let's go out to May. That's our next expiration month. So what strike can I sell for $75? Look at that. I can sell the $700 strike. So remember, we had been here at 750, and now we can roll all the way down to 700. This is pretty good, actually. Of course, this is going to change a little. This will be a little bit different when you're closer to expiration. But you know, this is not a bad deal for us. This is actually working okay for this strategy. All right, so we now know that we can buy back our 750. Because that was the April one, okay? We can buy that back for 75. We can go into May and we can sell the 700 for $75. Not bad. All right, what's the next step here? Next step is going to be decide if you're comfortable with this. You know, you're going to be looking at the chart and stuff, and it's like, okay, is this a good place to be? Am I comfortable with this? Do I want to be a little farther out? Do I take a little bit of loss now maybe and get farther out of the money? Or maybe I want to collect a little more money. Maybe you think that shop is going to shoot up now, and maybe you want to actually collect a little extra premium. You could do that. I don't think it's advisable, but you could. Maybe you sell the 720. You can see that that's deeper in the money, but you get an extra 10 bucks, right? So that may be tempting for you. I like to play it around sort of break even, because I'm already going to be making, if this expires worthless, I'm going to be making the original amount of money that I'd already collected on this, right? I'm not really kind of in this to make extra money. I'm just sort of in this to work my way out of the trade. But maybe you see it differently. All right, so you're comfortable with that. So you're going to go ahead and you're going to buy your short put back and then sell this new put. So you'd be short another put, short a new put. Okay. And so now we've got to wait and see if this is going to expire worthless. We can buy it back when we can. I like to, anytime I'm short an option, I like to buy it back when I've collected, or when it's only worth 10 to 20% of the option premium that I've collected. So, going back to our example here, we sold this for 75 bucks. If we're still a ways out from expiration and this thing is now way out of the money, and this is only worth, say, $750, I'm going to buy that back. I'm going to be, okay, I'm done with this. This still has a bunch of time left in it. I don't want to take any more chances here. I'm basically buying it back for next to nothing compared to the amount of premium I collected. It's time to buy this back and just get out of this trade. That's the way I would like to work it. You don't necessarily have to do that. I think it's a smart play. It's the risk adverse play. Maybe you want to wait and let it expire worthless, and that's certainly an option that's available to you. Now, if you're not able to do that, if it's not expiring worthless, if it's going to expire in the money again, you can just repeat the process and just continue to repeat the process until that finally expires worthless. Now, you do have to be careful because the numbers here can start getting really big. And they can start looking scary. Because if you go 2 or 3 expirations in a row where you have to keep rolling out, the numbers will get larger and start to look frightening. But because of mean reversion and everything, right? And eventually the stock, if it was a good company, is going to start moving in the right direction. Eventually, that will expire worthless. And I've been doing this over and over, I got countless times, both with calls and with puts that I've sold. And I've gotten pretty deep in the hole. I had one in cost not long ago where I think I was up to $8,000 or something. I had sold a call for, or collected $8,000 worth of premium. It just worked its way up there from a few $100 because I went 4 expirations in a row where I just had to keep rolling out, and then on that last one, it expired worthless. So eventually it will, but it does get the numbers get kind of scary. You just have to, kind of have to know that the math sort of works and trust in your stock that eventually there's going to be, in the case of this call, eventually there's going to be a pullback. In the case of the puts that we're selling, eventually there would be a bounce, that will take you out of this, give you the opportunity to get out. And so finally, if you ever get in a situation where you need to do a roll and you're not exactly sure how to do it, don't be afraid to ask for advice. There's some really smart people in the Discord period, but in the options channel, there's some really smart people in there. I see the Banknote is here. Banknote knows how to roll options, and I'm sure he'd be happy to answer any questions that are put into the options chat. Because it can be a little scary doing this the first time around, but it really is quite simple, and it is a good way to work yourself out of yourself out of the hole if you've got dug into one by any chance. So does anybody have any questions on how to roll or anything we've discussed today? Because we have gone right through that strategy and you guys are ready to go out and use it. So if you've got any questions, this is a great time to either throw them into the chat or go ahead and unmute and let me know how I can help you. Okay. Well, I guess everybody is either just totally confused and doesn't know the questions to ask, or I've done such a great job, you're all going to rush out and start selling puts on companies that you want to own. Okay.
I think it's the great job.
Thanks, Kelly. I appreciate that. All right. So, looking ahead, so this is what we've covered so far. I'm not sure where we're going to go next. I've been giving it some thought, and I'd love to have some feedback for everybody else. Anybody who's watching right now, or anybody who's watching the recording, if there's something that you'd like to see, if there's an option strategy that you'd like to have explained in more detail, go ahead and either DM me or send me tag me in one of the channels in the Discord, and give me some ideas for things that you'd like to see, option strategies that you'd like to cover in the future, and I'll be happy to include them. About a month from now, we'll be doing lesson number 4, and like I said, we'll see what that's going to be. Coming up, I believe this weekend. On Sunday at noon with Nick, he will be doing some stock fundamental analysis. I thought people were going to vote on a company, but maybe not. Maybe he's just picking a company that he's going to analyze for us. So those are always interesting. Always get some good ideas out of Nick's analysis. So I like going to those and checking them out, and I know that lots of you guys do as well. And Chems, you're welcome. Thank you. Thanks for the feedback. I'm glad you enjoyed this. That is it for today. So thanks for coming, everybody, and I look forward to seeing you again soon. I'll I've got a ticker talk coming up a week from today. So I know I'll see some of you there, and we'll see you next month for our next options lesson. So hope everybody has a great afternoon, and we'll see y'all soon.
Recording stopped.